Welcome to another episode of Leverage Addicts, and today we have one of the top advisors in New Zealand sitting across me, Zhiyang Cheng. Been working with us for a few years now. Just started from the client success team, or back then we called it the servicing team, and just servicing our clients and then just understanding properties, understanding mortgages, and really he just got better and better and better and better. And now, if you just Google him, he will be in the top 10 in the last couple of years. So welcome, Ziyang.
Thanks, Brandon. You're making me blush.
So today, the reason why I got you on is because you have not only, tried to do the mortgages for the client, give them advice around how they could build their portfolio, but you really went into doing it yourself, and you've built a pretty decent portfolio in the few years that you've sort of started working with us. And so now, because as a tradition of the Leverage Addict podcast, you have to tell us how much debt you have.
Cool. Yeah. So as of today, roughly around $4.5 million of lending. So
$4.5 million. What's wrong with you? Why would you want so much debt?
and debt is good, Brandon. That's why you taught me. I guess a bit of background about myself. I'm a Chinese-born Kiwi. Been in the industry for 5 years. As Brandon
You're
mentioned.
Chinese?
Yeah, so property was something that's always been in a conversation in our family. Yeah, I guess like from a very early age, parents were always talking about property. They weren't what you call, successful property investors, but just by purchasing properties throughout the years, they've done pretty well for themselves.
Were they the first generation, if I may interrupt? Like, were they like sort of came here and they just brought you guys over as well?
Yeah, that's right. So parents came pretty much with relatively nothing, working lower than minimum wage jobs at the time.
How did they move to a country like this, though?
I think at the time, New Zealand was pretty open to skilled migrants. So I think my parents they had a university degree, and that's all you needed really to come to New Zealand. Working at Mortgage HQ, I've seen the success of many clients through property. A lot of them, they didn't really start with much either, but obviously through the compounding effect, through many years of investing, they've done really well for themselves.
But how do they know if they sort of come here with sort of like very little? How did they know to get into properties? Like, what was it that made them think about, to buy more properties?
Yeah, that's a really good question, actually. My parents, they were never actually, like I mentioned, they weren't property investors. I would call them accidental property investors, whereas every single property that they've purchased was for us to live in. We started off in South Auckland as our first house, and then moved to East Auckland for obviously myself and my sister to have a better education. And then, yeah, they just didn't sell their properties, and they kept their properties that they purchased in the past. So they didn't actually have a strategy in place to build a portfolio, but it was more so accidental.
But even that made a huge difference.
100%. 100%. Looking at their position, if I knew what I knew today and I could add value to them back then, they would be in a much better position as they were today.
Relating back to your story, because my parents, I wish I could have told them to hold on to a few more properties, whereas they just sold it to pay down the debt.
My parents did the exact same thing. They wanted to sell their properties, but at the time, I think it was during the GFC, they bought their house at the peak of the market. They wanted to obviously move into the new house before selling the previous house, but the challenge was as soon as they bought the new house, the prices plummeted significantly. So they thought, hey, look, let's just keep it. We'll rent it out. It's going to be a bit of pain, but yeah, maybe in the long run, we'll see some gain.
And how much did they buy that house for, and what is it worth now?
So at the time, I bought it for in 2002. They bought it for maybe $340,000, and when they were going to sell it, it was going to be worth around just over $500,000. So today, it's worth probably $1.5 million. So yeah, probably 4x since they bought the property 20 years ago.
So that's the lesson about just holding on in the long term, because even if you bought in the peak, it seems like, man, such a bad decision. But if you could ride out the storm, you can come out the other end.
Yeah.
So interestingly enough, you said, okay, well, you looked at client situation, you learned from what they've done, apply it in your own situation. So then why did you decide to go and do it yourself?
Yeah, I guess for me, it's, property is definitely a tool to build wealth, to build passive income. And the great thing with property is that we can leverage on it, right? So we don't actually need to have cash. And the other thing is, what are the alternatives, right? So we know that it's going to be pretty hard to save yourself to being wealthy.
Yep.
So what are my options? You got properties, shares, cryptocurrencies, bonds, etc. So to me, property is the one option that made the most sense.
So that's a good thought. Looking at the alternatives,
Yeah.
and obviously some of those alternatives, they don't have leverage as well.
Yeah.
And that makes a property ever so attractive because the banks are allowing you to have really good terms on the mortgage. You can even have interest only. So you have some rental income to pay for the mortgage, and that really makes a lot of sense. So how did you get started in your first property?
I had a bit of a deposit saved up for a couple of years, and I bought my first one in Christchurch. That property was a home and income, I think around like $900,000. At the time, the LVRs were 20%, so it was a lot easier to get into an investment.
Means that you can put a smaller deposit
Exactly.
into
So
to
twenty
invest in the
percent,
property.
yeah, 20% deposit for a So right now it's 40%, but at the time it was much easier.
And why did you decide to buy this particular property? What was it that you were looking at, like from what you've learned from clients? What did you apply there?
I guess with this property, the main thing was I was searching for the cash flow. I also wanted to have a property in a major city as my first property. At the time, the numbers were really great. Like if I were to hold on to it, the per annum cash flow would have been like just over $20,000.
So it was cash flow positive.
It was, yeah. So it didn't put any strain on my situation at all. In fact, I would actually make money by holding this property.
Yeah.
So that was the thought process behind it.
So essentially, if it's 20% deposit, you're getting 20K. You're getting like 10% cash on cash return.
Yeah, I mean that's at the time, right? That's when the interest rates were around like 2.5%, 3%.
Man, like I wish I had that kind of wisdom on my first properties, but that's really awesome. And so as you progress, I remember you bought that Timaru multi-unit. That was a huge project. You just had all the units rented out. It's like 6 units or something. And that one was like 11% or something after you finished.
It's roughly 11% after finished. So a bit of background on that one to buy that property. And obviously at the time it was 40% deposit. So I didn't have anything at the time. So I went to mum and my cousin and I said, hey, look, this is a really good deal. We have to do this. And I had a little bit myself, like nothing significant, but mum and my cousin put together some deposit and basically they couldn't borrow money. So I was the one that went in to borrow the money. And they just came in with a deposit. So
it was a win-win. I mean, how did you split the deal in the end? Is it just a loan that you have from them, or did you give them like, hey, an upside, say, if you sell in the future, there's a profit share?
Yeah, I mean, for mum, it's not much agreement. She just let me do whatever. But with my cousin, it's he put in half of the deposit required. Essentially, by me borrowing the money, it actually increased my borrowing position by holding this property. So I said, hey, look, I will take over the whole liability of the debt, and then you give me half of the deposit. I'll put in the other half, and basically we just 50-50 on everything. So the income, the equity, the upside, everything's 50-50.
I really like that deal because it wasn't just a great deal itself, but there was a bit more creativity in terms of how you wanted to structure it, how you sort of get people together, give them a return, and then look at the strength and weakness on all parties.
Correct.
And then you create value because basically you're covering for each other's weakness.
Yeah, 100%. And I think that's quite important in today's market as well. As you know, like it's not very easy lending is a lot harder than before. So yeah, I guess it's important to be a little bit creative in how you can make things happen in this current market.
So if you had to reflect back into your investing journey so far, right, you're at 4.5 mil debt. That's quite a few properties. Yeah. So what are your 2 to 3 biggest key takeaways or lessons that, you wish you could do it again, or you would tell your earlier self if you could?
In 2021, as you know, what happened with the property market, everything went 20-30%. Yeah. So at the time, I was also really keen on getting in the fund. I also bought a property that was a land bank with a really low cash flow with the intention of potentially developing in the future. That property at the time was a very good deal, but if you look at it now, it's probably like a pretty average deal. So I guess one of the lessons is it's what Warren Buffett says, right? Be greedy when others are fearful, and then be fearful when others are greedy. So at the time, I was being greedy when others are also greedy. So I got burnt a little bit there. Like I said, for me, it's property is a long game, right? So my parents suffered the exact same mistakes throughout the whole property journey. Every single time they purchased property, it was at the peak of the market. It was a bit of pain at the time, but if you ride it out for long enough, then it should be.
So what would you do differently about that deal? Like, obviously, how do you know? Like, how would you know you're in the peak, and what would you try and change?
How would you know you're in the peak? It's quite hard to identify. I mean, it's clear, but also hard as well. You don't know when we're exactly at the peak, right? Like you could say the peak was in 2020, but then we still went another 20% after 2020. So it's quite hard to identify when the exact peak is, but when rates are that low, cost of borrowing is extremely cheap. That's when people are flooding into properties. So that's when people are greedy, right? When money is cheap.
Then if you were to go back, like how would you approach it differently? Like would you still buy something or would you set different criterias?
Yeah, I guess I would set different criterias. If I were to buy, I would be buying properties that had good cash flow, because obviously if you have good cash flow, it's cash flow neutral. It doesn't matter if it goes up and down. You can hold on to it and basically, it's self-sufficient. But with this deal, right, at the time it was already cash flow negative and the rates were, in the threes. So now the rates are at 6%. So you can see it's going to be significantly cash flow negative. Yeah, so I guess, yeah, setting the different criteria and what I want to buy is probably what I would do.
So setting criteria, like were there other lessons that you feel were valuable for someone who's like newer or just sort of getting into it?
The other lesson is probably just, it's you have to identify what's going to be suitable for your portfolio, right? So at the time, that buy was more like, for me, that was an impulse buy. I wanted to, get in the fun. I don't really need that property in my portfolio
Mhm.
because, like we had a bit of equity from, obviously I haven't said this already, but I had access to a few of my parents' properties for equity. Actually need any more equity. What we needed was more cash flow. It's about identifying what you need in your portfolio as opposed to just buying what you feel is right.
So trying to look at the portfolio overall and just seeing what the needs are opposed to, like, would you say strategy over perhaps looking at the overall portfolio? Like, would you just stick with one strategy or would you try to maybe modify like the portfolio based on what it needs?
Everyone should have a different strategy, right? Like there's no one size fits all, and it's all dependent on like where you are financially. Like for example, if you're a bodybuilder, sometimes some people might have stronger pecs, some people might have stronger legs. It's really about figuring out what your weakness is and working on that.
So if someone is trying to get into property investing like in the current market and perhaps they are looking for something that has got good capital gains, what would you sort of recommend them look at? Like what are some strategy that you think would be more fitting?
There's so many strategies for capital gains, right? If you want equity gain in the long run, basically every property in New Zealand is going to have capital gains. Like if you look at the graph over the last 20, 30, 40, 50 years, there's no area that significantly outshone another area. People say Auckland is going to be better. Technically, it's not false, but you got all the regions experiencing similar gains. Yeah, I mean Auckland is always going to be a great place to invest in, but the problem with Auckland is that we're going to have pretty bad cash flow. If you're going in with a small deposit and you're borrowing majority of the money in today's environment, you're going to be paying a lot of money, like probably around just the 1 mil properties. You're going to be down maybe 30, 40, maybe $50,000 a year just by holding it. So yes, like capital gain is going to be there in Auckland, but it costs a lot to hold it.
So would you say that really depends on the person's sort of financial position, like depending on like what their cash flow looks like,
Correct. Yeah.
they
So
might make a different decision?
so if the client has, if they got a high paying job and they can hold on to those properties with their personal income, then it's not a bad choice. But if you're a client whose the income is already quite tight, then it's probably not a great choice to look into an Auckland property.
Okay, let's just say I am happy to put in 35,000, 40,000 a year
Yeah.
into the property, sink it into it,
Yeah.
even if it's on negative cash flow, but I want really, really good upside.
Yeah.
What kind of properties would I look at?
I would say properties with good location, first of all, and good development potential. You've seen what happened in the last couple of years, right? The properties that had the most capital gains were the ones with a bit of land in a good location. If you're happy to sink the money in, 30, 40K a year, then you can't really go wrong.
That is a good sharing. So, what about if something or someone is looking for cash flow? What are we looking at? What type of properties?
The most obvious one is a multi-unit. So you might have a property that has 4, 5, or even 6 units on one title. So typically, those will have much higher cash flow. So in today's market, I'd say you could look at getting 8% plus on those sort of deals. If you can get social housing on top of that, then obviously it's much better because then you've got tax deductibility. The second thing is home and income. Home and income is just a house with another income on top, potentially like a minor dwelling or another legal unit that you can rent out. So those are typically going to be higher income as well. Yeah. Thirdly, single houses that are in a cheaper price bracket that have more rooms. Those ones have pretty good income as well. So you get 8% plus on any of those deals.
That's great. For you, with your property investing, what's your focus at the moment? What's your next goal? What are you wanting out of the portfolio?
Yeah, so for me, I guess at the moment, I want a bit of a challenge. The cash flow stuff is pretty cool. I always want to add like one cash flow every year or every 2 years. For me at the moment, I'm working on a development project on one of the sites. It's just I just want to challenge myself and get out of my comfort zone. Yeah, that's my focus this year, and that's going to be like a 6 lot development in Point England.
After learning about your portfolio, perhaps you can share a little bit about your mortgage broking and that side of your work. What do you do for clients?
Yeah, I guess for mortgage brokering, the main goal was to bring them from what we call a mortgage life cycle, right? We got stage 0 or all the way to stage 3. Depending on what stage they are, we want to push them through to the next stage. So essentially, the end goal is always to become financially free, and that's in stage 3. What we do is we assess our client's situation. We would provide advice on what actions we need to take in order for them to go to one stage to the next.
And so for you, perhaps you can tell us a little bit about like some of the clients that you have helped. Like what are some of the results that you help them achieve that sort of motivates you and keeps you going?
Yeah, we got clients coming with just one property, and they got brokers saying that, hey, look, they you can't do any more. This is your income is kept. For us, we're more solutions based. So what we do is we look at the client situation and say, hey, look, maybe there's more avenues we can take to grow your portfolio. So in that client's situation, we did a few things, but ultimately we had to sell down one of our properties that was a lower yielding property. And then we managed to build a portfolio that had probably 6 or 7 properties in the span of a year.
That's great. So if somebody wants to talk to you or sort of reach out or get some advice from you, Zhiyang, how can they do that?
Pretty easy. All the advisors in our company are really competent. Myself, anyone else you can reach out to. All of our details are going to be on the website.
So just so you guys know, Zhiyang's actually basically our representative for the advisory team. He's really lived what he preach, and so yeah, he's going to be great help. And I think he's really getting the younger advisors to really step up and just try and encourage them to do the same. Living what we preach. Appreciate your time, Zhiyang. And if you guys want to learn more, check out the YouTube channel Mortgage HQ. And then if you are really wanting to sit down and read a lot as well, we've got our own book, the 3PF. You can purchase it on our website. Until next time, I'll talk to you guys again.